Welcome investors, and thanks for joining us on your Investment Advisor channel, where we decipher the markets so you can make actionable investment steps. I'm Jake Ackerman. Inflation does not decline month over month. Jobs numbers show that companies are still hiring. However, unemployment numbers tick up much higher than expected. And just what the heck is everyone talking about when they say raising interest rates, tighten monetary policy? Let's just get right into it. All right. Thursday, PCE, personal consumer expenditures, the inflation data that the Fed highlights every single Fed meeting, that's the number that they're watching. What does it do month over month? Let me put it right on your screen here. Expectations, 0.2%. What do we get? We get 0.2%. However, you'll see that number that's underlined with that black ink there. That was last month's reading. Last month's reading was, again, 0.2%. So what's that saying? That's saying that PCE did come in as expected. That's why the stock market, the bonds market, asset markets really didn't respond. So when we get a data point that comes in as expected, a lot of times the market has already priced that in. It's the surprise that causes the markets to go up or down. But here's what's going on. So last month, inflation came in the exact same reading as this month. So, you know, the objective of the Fed, why are they raising interest rates, is to bring inflation down. Inflation last month and this month shows us that inflation didn't come down over this last month. So that is, again, that is potentially a problem for the Fed. They want to see inflation come down. Granted, they probably know that nothing comes down or goes up in a straight line. So, you know, we still don't really know where their head's going to be at the end of this month when they do have that next Fed meeting. However, we're going to get more data before that time period, and that'll probably give us another reevaluation. So next, we got some data this morning, Friday morning at 8:30. Non-farm payroll, which is jobs numbers, inflationary. If more people are hiring, that's showing strength in the economy, potentially leading to more inflation. However, unemployment throws a little wrench in that. So let me put this data up on your screen here. Let's take a look at it. Non-farm payroll. It's pretty self-explanatory. Employment or jobs numbers of people hiring, except for the farming industry. Expectation was 170,000. Well, we got 187,000 new non-farm payroll jobs. So that's giving signs that there's strength still in the economy, strong. If companies are hiring, that shows sign of strength. However, that unemployment rate, expectation 3.5%. We got 3.8. At the same time, companies are hiring. More companies are laying off employees. That's why we're seeing that unemployment rate start to tick up. And that is a sign that the Fed wanted to see. They want unemployment to tick up, but they also want the job market to stay strong, which is an absolute conundrum. And it's a balancing act that the Fed is trying to toe this tiptoed line. And somehow they were able to navigate this so far. But again, we are still in the early phases of feeling the ramifications of them hiking interest rates, tightening monetary policy. So 12 to 24 months after they first begin raising rates is when we really start feeling it. March 2022 is when they started raising interest rates. We're now September 1st of 2023. Not quite to that 24 mark when we can start feeling it. So early phases, we're just starting to see the cracks, which is what the Fed wants to see. But again, you know, they because inflation isn't still coming down, do they keep their foot on the gas pedal and raise rates one more time? More data is going to give us the clear picture. Okay, so I've had clients ask me, you know, when we're watching CNBC, we're watching any money channel, where we hear the Fed's tightening interest rates and they're tightening monetary policy. And I've had clients ask me, and staff members ask me, Jake, what the heck does tightening monetary policy mean by tightening or raising interest rates? And there's a couple things going on when they're raising interest rates and tightening monetary policy, right? All right, so number one, when they raise interest rates, that makes being able to obtain credit, borrow money, more difficult. And a couple reasons for that. One is interest rates are higher. That makes the cost of borrowing higher. So as a borrower, as a consumer or as a business, I got to pay a higher rate to borrow money. So And if I'm not going to get my return on investment with that higher interest rate or that objective that I'm trying to read as far as return on my investment, maybe I don't borrow. Maybe I postpone borrowing. And what does that do? It brings less money into the system, less money into the economy. I can't borrow money to do the improvements. If I don't do the improvements on my building or improvements on my warehouse, whatever I own, the maintenance crew, the builders, who's ever doing those improvements doesn't have a job. They're not getting paid to go in and do those improvements. I'm not expanding, and then if they're not getting jobs, they can't pay their employees as much. Or they're not hiring because they're not expanding. So that's one way. We're not getting credit in the system because borrowers don't borrow because the cost to borrow money is more expensive, and therefore I don't do it. For your typical consumer who wants to go buy a house for their family, buy an investment property for their portfolio, the investment property no longer makes sense because they can't get the return on investment. I'm looking to get a mortgage. The bank says, hey, your debt to income ratio looks good, but now the interest rates, maybe your debt to income ratio doesn't look as good because you're going to have a higher cost to borrow, and that no longer makes sense. Guess what, Mr. and Mrs. Family? You can't get this 30-year mortgage on that house because your debt to income doesn't line anymore. The next thing, what raising interest rate does, it no longer makes sense for banks to borrow. Banks become less profitable, then they don't longer lend money. And the reason for that is how banks lend money is simple. I'm going to make this simple for you. They borrow on a short-term rate and they lend on a long-term rate. They borrow on the bank rate, which I don't want to complicate things by telling you the bank rate, so I'm going to give you another example to keep things nice and simple for you. I'm going to pull up on your screen the 2-year Treasury yield. So let's take this for example. So let's say, again, banks borrow at short term and they lend at long term. And short term means they borrow at short term debt rates and they lend at long term debt rates. In a normal, healthy economy, normally long-term rates are higher than short-term rates. But what's going on right now? So that 2-year rate on your screen there, 4.793. If I was a bank and I'm borrowing on that 2-year rate, I have to pay that interest rate to whoever I borrowed that money from. But I want to get a return on my investment. So I'm going to lend that at a longer-term rate because I know that longer-term rates are going to give me a higher return, and I'm going to get that difference in between that short-term borrowing rate and that long-term borrowing rate. So let me show you the 30-year Treasury yield. What is going on with that? 4.246. So you see the problem. I'm borrowing on a short-term, and I'm paying a higher interest rate now because the economy's sick, and I'm lending on this longer term, which obviously I'm not doing that right now because that wouldn't make any sense. So that causes banks to not lend money because they can't make money. So you have the consumer, your businesses, who the cost to borrow is too much. That means they're not spending, they're not getting money out into the economy. Banks aren't lending to those businesses and consumers, but because again, it's not profitable for them. So this is what causes tight monetary policy by raising interest rates. So hopefully this gives you a clear picture into what's going to happen the next couple weeks. I know that's not the case because the Fed is being data dependent, but this gives us a clear picture of what's going on this first half of September. Rest of the month, we're going to have some more inflation data. We're going to have some more jobs numbers that the Fed is going to make their case. Either they're going to raise interest rates one more time or they're not going to. The bond market right now, the interest rate market, shows that there's another interest rate hike coming. Do we get it this meeting? Do we get it sometime later this year? If we start to see more cracks in the economy, maybe that becomes off the table. So stick with us. We're going to help you navigate the storm on the horizon. Expertise you deserve, experience you can count on.